All right, with Group C as master dividends, ex-dividend date has passed, so therefore recent prices are reflective of that dividend payout. So for those who don't know, the ETF price, once the ex-dividend date hits, ETF price usually will decline by roughly the dividend amount to reflect that dividend is no longer part of the ETF, but will be paid to whoever owned the ETF prior to ex-dividend date. So with that said, I just want to do a quick breakdown. Specifically, I want to cover, with Group C done now, since inception date of these funds, what funds have been doing the best, which ones have been doing the worst. And then I want to dive into CONY and NVDY just real quick, show what positions they own currently, looking to the end of this week and the week ahead. So to jump right into it, I updated this table, hopefully make it a little bit more visible, increase the font size, and made it a little darker, so hopefully you can see it. But here I got it sorted by total return percentage since inception date for these funds. The bars over here reflect how the funds have done with their most recent distribution based on a percentage of the ETF price. So these bars, and I guess the percent return column here, reflect what funds have been the best based on the most recent dividend from paying a percent distribution based on the ETF price. But as far as a total return since inception date, if you filter on this column, that will show you basically what percentage you're looking at. The way I figure it is I take the ETF price and then I add that to the cumulative dividend that it's paid since inception. You add those two components together, you get a total return metric, and then you can divide it by whatever the initial price was on its inception day. For most of these funds, it was 20. Some of the more recent funds have been coming out at 50, so it's probably either 20 or 50. The only one that's not that is Tesla. I'll get the name here. So Tesla, they did a reverse split, so they did come out at 20, but since they did a reverse split, it's effectively kind of 40, the way to look at it. So with that said, I did sort these based on their return overall, and I look at this myself to see which funds are better. I also use it to think which one of these funds pay the best. Do you want to get one that's more stable, or do you want to get these more volatile names that the ETF price might go up drastically or down drastically, but they always pay a pretty good distribution every month? And so you can see overall, if you look at the top 10, we got Misty, NVDY, Palantir, CONY, Netflix, Robinhood's, Facebook. Let's see what that is, 6, 7. So Amazon 8, Microsoft 9, and Block or Square or XYZY at 10. And then Snowflake also, I think that's a good fund at number 11. And I just want to note that I'm only looking at the YieldMax funds that are tied to a single underlying equity. I intend to cover the weeklies here soon. I don't got that data in yet, but I'll cover those later. I do some of the weekly funds, that's YMAG, YMAX, LFGY specifically. I know Ulti's been a fan favorite lately, although it got crushed right off the bat, but Ulti's another one. I'll add that list here and hopefully compare the weeklies to some of these single stock exposure ETFs. But overall, I guess my conclusions is Misty, NVIDIA, Palantir, CONY, at least the way the market's been lately, it seems like you want to own these funds that do have the immense volatility or the high implied volatility. Causes maybe some more volatility in ETF price, but the distributions that come in are quite large, and cumulatively as they stack up, they give you a pretty good return. Misty, of course, is the best. It started at 20. It's currently over 20. So just owning the ETF, you're positive. But then also don't forget they've paid almost a $40 cumulative dividend. So you got like over 200%, and most of that just lies in the cumulative dividend. NVDY is down slightly since the inception date, but that's also paid a very large cumulative dividend. And then one other one to note, I've noted before, CONY down over 50% since its inception date. But you look at the cumulative dividend of $30.68, gives you a nice 100% return. Overall, these are from the inception date. So all these funds, it's basically from the dates noted here. So it's not a like-to-like comparison because some of these funds are older other funds, so they've been around longer. But when you look at Robinhood's, this one's very recent. That's already got you a 65% return, with the cumulative dividend already at 16.70 when it came out at 50. So you've already got 32% return just on the dividend over 3 pay periods. As far as the worst ones, I know, guess Murney, this one's clearly due to the destruction from Moderna stock. The thing I like to note, though, is even though it went from 20 to 2, basically, the cumulative dividend of $11.38 make it so you're only down 30%. Of course, it's a lot, but it's probably nowhere near what someone would guess somebody's down on that, assuming they owned it from inception. And lately, actually, the Murney distributions have been pretty good. And you can see like the most recent one was almost 8%. Although it's been destructed, maybe this is like an ulti. It's been ravaged, but I don't necessarily have a opinion on where it's going in the future. But if you think you can hang around the 30 stock price, Moderna, the underlying stock, maybe that's a decent one to own. But okay, then Morrow, negative 27%, AIYY, negative 26%, SMCY, negative 13%, XOMO, negative 3%. The one thing I like to note, though, is if you look at these funds, I know the market's been pretty good, so it's pretty hard to be losing money on something. But in general, a wide majority of these YieldMax funds are positive. They might not be doing as well as the underlying equity, but you can see that cumulative dividend does add up and contributes significantly to the total return. But yeah, that's just a quick cover of the single stock exposure YieldMax ETFs. Then just real quick, I want to jump into, you can tune out if you're not interested in this. This is the into the weeds. Just a real quick summary. So looking at NVIDIA here quick, it's the 724 today. So all these options will expire tomorrow. They got them sold at 175 and 177.50. Currently, the stock price is below 175. So if it stays below 175 and tomorrow, these will all expire worthless. They don't got any new contracts open yet to what I can see for 8/1. So I guess overall, you're looking at these contracts look to be sold at a pretty good price. So it looks like you're taking in all that premium if it doesn't hit 175. Even if it does hit 175 tomorrow, it's probably not going to shoot way over them. So pretty good job by the team at picking those strike prices. From a fund makeup perspective per share, you can see we got like a 1680 ETF price. Most of that right now is in the cash and cash equivalents. And the synthetic values are making up 46 cents. The other contracts are just about zero because we got a day left to expiration date. So basically, and I'm just looking at the NVDY, it looks like we are higher, over 17 right now. So this was probably pulled in the morning. But yeah, overall, those other contracts are looking to hopefully expire worthless. As far as how the fund is structured right now, there's 110,640 contracts that they can use. So if you take that contract times 100, that's the number of shares they got technically collateral to. And they have sold, not all, they haven't used the entire position to sell calls against. They got 28,000 just sitting there with no capped upside. So they got the same exposure as NVDA stock. And you can see even the ones that do got sold, they got a lot of credit call spreads sold. So they got like an insurance rate of 57%. Then just one, if you look at the market cap, you can see the fund continues to grow, shares outstanding continues to grow. But then the market cap from the positions, just interesting because we got 1 day left. So these funds on a per share basis, looks like the 175 strike is acting as a 7-cent drag right now on the stock. Or not a 7 cent, sorry, a 1.3 cent drag on the stock. And this other one is about a 1 cent. So assuming those expire worthless, the ETF price will likely increase by that much. And then I guess jumping over to CONY, another one really quick. So on an in-depth basis here. And then just as a quick note, if you ever look in these charts, you want to see like how current they are. If you go to the market cap shares tab, you look at the date, you can see it pulled in as of 7/24/2025. So it shows you like when it was last updated, basically. That said, it might have been updated in the morning or the afternoon. So it might be a kind of a day, even if the day is today, it might be like a day or so variance. But over in the grand scheme of things, not that much. But CONY, so we're looking at here, we do got 725s that expire tomorrow with the, let me just give a quick check on Coinbase underlying equity. So this position is on Coinbase stock. So CONY is the ETF, but what they sell calls on is coin, the underlying equity. So right now I'm seeing Coinbase stock at after close, it's just under 400. When I pulled it, looked like it was about 405, but their contracts at 425 440 and end up. Those all look like they're probably going to expire worthless tomorrow. They will establish some new positions. That said, they already have one established on August 1st at the 435 strike, 12,590 contracts. Fund makeup on a per share basis. CONY they just paid out their dividend, or they just went ex-dividend. So the share price fell by roughly what the dividend was. So they're sitting just above $9 a share, most of that in cash equivalents. The synthetics are adding 20.3 cents. And their other contracts that they have sold currently are acting as almost a 6-cent drag on the fund. Why do I say drag? Because they have the cash from selling them, but they also have the liabilities from selling them. So the cash is in the cash amount and the liabilities are over here. If the contracts expire worthless, they keep the cash, but this goes to zero, thereby pushing the ETF price up. As far as how they're structured right now, this is always going to change because we're just about at the end of the week, but they have 36,950 contracts. So roughly times that by 100, that's how many shares they have collateral to. They have contracts sold against a lot of it, but they got about 4,600 contracts. They don't have any contracts sold on them. The ones they do, they got 5,560 shares of insurance, 15%. And from an overall fund, once again, continues to grow. Looks like the market cap. So the market cap here, looking at this, I'm just thinking about this. It just went down. The shares outstanding stayed roughly the same. I'm guessing this is so the market cap's effectively equal to the shares outstanding times the price. The price went down because I just paid the dividend, or went ex-dividend date, which ex-dividend date means the funds they had allocated to pay out, they basically moved from the bucket of being in the ETF or ownership of the ETF to ownership of shifted over to ownership of the person who owns the ETF. So the ETF no longer claims them. So its value went down just based on paying those dividends. So that's nothing to worry about. But yeah, overall, that's an update on CONY, NVDY, and then kind of like the top ETFs so far. So thanks for tuning in.